In this video, we're going to talk about the effect of depreciation and taxes into the calculation of the present worth of projects. And without any further introduction, let's talk about the project in which we have an initial investment of $300,000 and the life is 7 years. The Macris classification allows this project to be depreciated in 5 years. The tax rate is 35%. The salvage value at the end of the life of the project is $45,000. And the minimum attractive rate of return that the investor wants from this project is 15%. So at the beginning we have the most left column, the end of year, that it's at the end of any particular year which cash flow we would expect. We have the projected cash flow. The initial investment is $300,000 and we have a stream of cash flows that begin with $50,000 and it doesn't have to be the same for every year. So we have pretty good performance ramping up on the savings for the company by doing this project. All the way up to the 6th year, and then in the last year operation it reduces the amount of savings from $110,000 to $80,000. But since we have the salvage value in which the company can get to sell the equipment, we have an extra cash flow of $45,000 on the same year, the 7th year. The second column represents the Macris depreciation factor, and for this we are using the table for 5 years. Even if the life of the project is 7, depending on the nature of the project, that's what actually is used as the number of years for depreciation. So in this, depending on the type of investment, in this particular case, we're making the assumption we are allowed to depreciate in only 5 years. And the computation for the actual depreciation is expressed in column C. And in this example, this column C is computed as the factors that were depicted in column B times the row 0 in column A, the initial investment. So 20% of 300,000 is 60,000 and 32% of 300,000 is 96,000 and so on. Notice that the complete depreciation is for 100% for all these during the 5-6 years actually, because remember the Macris allows for the depreciation in 5 years, but since the first year only represents the first half of the year or 1/2 of a year, then we have an extra half of a year at the end of the life, and that's why we have to use 6 years. If we continue with the table, we have column D as a taxable income. The taxable income is the increment in cash flow or revenue that we have in this, for instance, 50,000 for the first year, minus the depreciation, because the depreciation is a cost. In this example, the first 2 years command a taxable income of negative value, 10,000, 26,000. And that's actually used as a negative value because we are making the assumption that this project is embedded in a larger corporation that might have other projects or other sources of revenue, and therefore effectively we are reducing the amount of taxes or by having a loss in the first 2 years. Column E represents the computation for the tax, and that is simply the taxable income times the tax rate, 35%, and we do that for years 1 through 7. Later we have the after-tax cash flow, and this has to do exclusively with cash flows because we're going to be affected by cash flows, not necessarily by the costs incurred due to depreciation. So we actually have to spend $300,000. We're making the assumption that this money is all out of the pockets of the investor, of the owners of the company, and we don't have any external financial sources. So that's why we have an initial investment of negative 300,000 full, and then we have only considering the cash would be the actual savings or revenue. For instance, in the first year, 50,000, and then we have to subtract the taxes. If the taxes in the first and second year are actually negative taxes, then we end up with a positive stream of cash of 53,500 for the first year and 79,100 for the second year. In the consecutive years or subsequent years, we have, say for instance, in year 3, 90,000, and we actually have some cash that is going to be spent on taxes for 11,340, and therefore the amount that remains for the investor is 78,660, and the same pattern remains for the other years. So some things that are worth pointing out are, first, the depreciation are only reference to the initial investment, and it's not dependent on the other cash flows. Depreciation depends on the actual acquisition of equipment, and we're making the assumption that the full 300,000 is equipment acquisition. Second point to use or to determine is that the taxable income is based on the cash flows minus the depreciation. Depreciation is a cost, or is considered a cost, even though we didn't spend any cash in such depreciation. The next concept to take into consideration is the tax is depending on the taxable income only. The next point to consider is the after-tax cash flow is exclusively related to cash flows. That we have to include cash. Therefore, it does not include depreciation. And the only columns with cash are the project cash flow and the taxes that we need to pay. So the computation of the present worth is done by taking all these after-tax cash flows and dividing them, each one of them, by 1 plus the minimum attractive rate of return raised to the corresponding period. At the end, we can add all these rows for the present worth, and we can compute the overall present worth for the project to be $7,766. In the next video, we're going to compute a similar project, but we're going to modify to include external financial sources as opposed to just using the money from the current investor.